Hey, I'm Adam Jusko from ProudMoney.com, and in this video we are going to look at how your credit score is affected by taking out a new mortgage. But before we do that, I would ask you to please subscribe to our YouTube channel if you have not already, and if you have already, I thank you for doing so. So the website LendingTree, which is sort of a broker of loans and other financial products, put out an interesting study over the last week or so, and they looked at how your credit score is affected by taking out a new mortgage and how long it takes for your credit score to recover back to the place it was when you took out that mortgage. And what they found is that on average, your credit score will go down by 15 points when you take out a new mortgage. They saw some buyers' credit scores go down by as much as 40 points, and then some people obviously had their credit scores go down less than that 15 points. But 15 points was the average. Now, the credit score does not go down right away. So what they found was that it usually takes about 160 days to get from the point where you are when you first get your mortgage, when it first closes, to the point where it actually kind of hits its lowest point, when it hits that 15 point drop on average. And the reason that it takes a little longer for that to happen is when you first get a mortgage loan, you close on the mortgage loan, but you usually don't have to start making your payments until more than 30 days after that loan closes. And so, because the way these things get reported on your credit report and then get factored into your score, that first payment isn't going to be due for a little while. So it's actually a while before your credit score drops and sort of hits its lowest point. Now, once it does hit its lowest point and you start to make your payments and you start to make them on time and do everything that you're supposed to do, obviously your credit score will start to recover. And what they found was that on average, it takes 11 months from the time that a mortgage closes to go, down to that lowest point and then recover back to the point of where you were when the mortgage originally closed. So almost a year, which is, a decent amount of time, but it also makes sense. Now, they also looked at this by city. So if you want to, you can look. I will put the link down in the comments so you could go and look at it, based on where you live. It will show you, what the average is of the score going down by city and also how long it took to recover. Not necessarily a ton of variation, but there are some differences in the cities. So if that's interesting to you, you can take a look at that. Now, in terms of why your credit score goes down by the amount it does, it's not really very surprising, especially if it is a first mortgage. You've just added a ton of debt, right? So you've got a big new debt on your credit report, and you've got a new debt as well. So those are both things that are going to ding you. So obviously your credit score is going to go down, and probably the less of a credit history you have, the more it's going to go down, because you're going to have, fewer credit lines. They're not going to be as old, whatever, and a new mortgage is going to make a big impact. If you're somebody that has a longer credit history, you're probably going to be, maybe one of those people whose credit score does not drop as much. So it's a significant thing to take on a mortgage. The good news is that when you start to make your payments on a mortgage, what you've really done is, even though it may take 11 months to recover or whatever it may be in an individual instance, once you have taken out that mortgage loan and you start making those payments, you're going to get back to that recovery point, and then you're really going to see some significant gains over time because of the fact that you have taken on this big responsibility. It's a lot bigger of a responsibility than, having credit cards. And so by paying that on time, not only are you paying on a significant debt, it also adds to your credit mix, which is one of the important pieces to how your credit score is calculated. So, if you just had credit cards in the past and you add on a mortgage loan, you've now, you start to show that you can handle different types of debt. If you have auto loans in there, the more types of loans that you have, sort of the better that looks on your credit score, assuming that you have made all your payments on time and, you don't have, any defaults or that sort of thing. So bottom line, if you get a new mortgage, you can expect that you are going to get a drop in your credit score. Looks like it's probably going to be about 5 to 6 months before you kind of, hit bottom, and then you will start to recover. At about 11 months is when you can expect that you'll be back where you were to begin with. And then from that point on, assuming you make all your payments on time and you're handling your other debt obligations as well, you should see your credit score go up significantly, especially if you are, this is a first mortgage and you have not had a mortgage as part of your credit mix in the past. So that is it for this video. Thanks for watching. Please go to proudmoney.com where we talk about other personal finance issues and we do credit card reviews and all sorts of other fun stuff too. Thanks for watching. Bye.